welcome back to You Heard It From a CFP. My name is Matthew Coyle. I'm the Director of Financial Planning here at ACG, otherwise known as Advanced Capital Group in Minneapolis. And today we're talking about episode 76, fake investments, things I don't want you to spend any money on in 2024. Let's dive in. All right, well, I hope you had a very nice start of the year. We are a couple weeks now, almost 3 weeks into January. It is time to get rolling and thinking about the rest of the year, about what investments you're going to make, what investments you're not going to make. By the way, I did get a couple of questions at the end of last year from people about this pen. No, it is not a scepter. It is a pen that a friend of mine used to own a jewelry store, and it's a fake diamond on top of a pen, and I got it for free. And I like free stuff, so I'm using it. It's a pen. That's it. Okay, so let's talk about fake investments in the new year. You know, I've been doing this for 22 years now, I think maybe a little more. And I see people put money into all sorts of things. I mean all sorts of things. And when I say fake investments, I don't mean scams. What I mean is things that have like the tinsel of an investment. They almost look like an investment. They have the feel and look and sound of investment. But trust me, they are not investments. So we're going to do 7 things. And a couple of these I actually like. So this kind of hurts at a certain level. But I'm going to do 7 things I don't want. 7 things I don't want you to spend money on in 2024. Things that look like investments, but they aren't investments. Let's start with one right off the top that I see all the time, and that is leveraged ETFs. Okay, leveraged ETFs. What is an ETF? An ETF stands for Exchange Traded Fund. Basically, it's a basket of securities similar to a mutual fund that trade on an open exchange, and they have a sponsor, and all the sponsors, major sponsors have them: Vanguard, Fidelity, Schwab, BlackRock, whatever. They all have them, okay? And lots of these are fine. I own index ETFs, active ETFs, whatever. Lots of my clients do. There's nothing wrong with them. There is a certain class of ETFs, however, that are called leveraged ETFs. And they are a particular form of nuisance that I've always had to deal with when dealing with client accounts. And I'm telling you, these are the worst things because they are guaranteed losses. So when you have a leveraged ETF, it's an ETF that uses leverage, hence the name leveraged ETF, to magnify gains or losses. They're usually used as a hedging position on short-term trades. So in that way, they do have a use. But I know lots of people who buy them on a long-term basis, and they hold them over the long term. Some of these are like they'll leverage the S&P 500 2 or 3 times over, or they'll leverage the NASDAQ 100, or whatever it happens to be, or they'll go short the market and do it 2 or 3 times leveraged. Literally, these are guaranteed losses if you hold them long-term, and I see them in client portfolios all the time. So please do not buy leverage ETFs. What happens is they reset on a daily basis. And one thing I don't want to see any more of in 2024 is leverage ETFs in long-term portfolios. Lots of investors buy them thinking they're sophisticated, that they really know what they're doing, and they're hedging their positions. If you really want to hedge your positions, find assets that aren't heavily correlated. That's a better way to hedge your positions than buy levered ETFs. Levered ETFs are not like open-ended mutual funds where they are priced once a day. They reset. Leverage ETFs reset every single day, meaning the losses compound if you're on the wrong side of the trade. So as you hold these things long-term, you're actually mathematically guaranteed to lose money. So in 2024, I want you to commit to yourself that if you own leverage ETFs, you will sell them and you will never buy them again. That is number 1 on my list. I see it all the time. Levered ETFs, do not buy them. They are fake investments. They are not worth the money. Okay, number 2, traditional variable annuities. Now, contrary to public opinion, and contrary even probably to the opinion of some of my own clients, I am not an anti-annuity guy. Been in this business for a while. I know annuities can work. And, a traditional pension is an annuity by definition. So is Social Security by definition. They can work. They can make sense. However, traditional variable annuities were invented kind of around the 1980s to compete with stock market investments. Basically, they're insurance accounts opened by insurance companies with mutual funds as the base of their value, but they just layer on the fees tremendously. If you have a traditional variable annuity, and many of you do, you should consider swapping that out for either an indexed annuity or just cash it out if it's not too damaging and you're not taking too much of a surrender penalty. So a traditional variable annuity is basically an insurance contract with a cap as far as how much you can earn. There's a guaranteed floor, how much you can lose, and lots of fees in the middle. There are fees for record keeping. There are fees for the mutual funds. There are fees for the mortality and expense charges. There are fees for the annuity themselves, the product fees. There's fees for the brokers that sell them. I don't sell them, by the way. Again, if you have a traditional variable annuity, consider swapping it out for maybe an indexed annuity, something that's maybe more passive, or just cash it out and maybe invest the money. I see traditional variable annuities all the time. They are massively expensive. The expense can range anywhere from 2, on the low end, 2% all the way up to 3, 3.5, even 4% annually to own these things. You will not make money long term, not really, owning a traditional variable annuity. Index annuity, different deal. Maybe that can make sense, and they often do, but traditional variable annuities, avoid them. They are not really investments. Separate your insurance and your investments. In the vast majority of cases, you are far better off doing that. In 2024, I hope I just never see another traditional variable annuity, although I probably will. And let's go ahead and just commit that we will not buy these things in 2024. All right, moving on. All right, moving on. Number 3, collector coins and coin sets. Now, you would be surprised how many people buy these things. Now, in order to do this one, I need to start with the definition here, okay? There is something called numismatics, okay? Numismatics is the study of coins and money, is basically what it is. If you look up numismatics, you can just jump on Google and look up numismatics. Numismatics often gets confused with collector coins and collector sets. Now, I'm a bit of a night owl. Sometimes if you're up late night, you'll see these advertisements on television, from places like the Franklin Mint or others, that advertise collector coins with a little bit of precious metals in them to commemorate presidents or events or important dates or whatever. I'm continually surprised how many people buy these things. They really don't have a value. They're purely collector value. They're what's called numismatic value, where they don't really have a lot of bullion or precious metal value. They really just advertise the collector value or the numismatic value. Now, I actually used to be into kind of stuff like this. So this right here is a 1961 Franklin half dollar. It doesn't show up on the camera very well, but there you go. Things like Kennedy half dollars. Now, these things actually have something like 90% silver in them, and they don't make them anymore. And there is a numismatic collector and bullion value to stuff like that. And I used to do this myself when I was a little bit younger. What I'm talking about specifically are collector sets that are sold by commercial endeavors. And no offense to the Franklin Mint, they run a good business, but you know what? It's not an investment. These things very rarely appreciate over time. Years ago, I think my parents got me like a Statue of Liberty commemorative coin set or something. I actually found it the other day. I looked up the value. It was worth about $1 or $2 more than what it was when they bought it. Looking back on it, I guess I just would rather have shares in the S&P 500. But anyway, numismatic value is different from actual bullion value. If you are interested in investing in coins, or rare coins for that matter, or bullion, there's some places I might suggest you go rather than just put money into a fake investment like collector sets. If you want to go buy bullion, what I would suggest, I used to be a member of APMEX, which is the American Precious Metals Exchange. Full disclosure, yes, they do sell collector sets, but most of their business is actually bullion, like direct from the government, like so that kind of thing. That is fine. That has a spot value. That has a value. It's a real investment, whether you like it or not. It is a real investment. But you can go buy there. That's one I would suggest. I've had experience with. I get no compensation for saying that. I think it's a free membership too. You can go to AppMex, sign up, and you can buy and sell bullion all you want. But I would avoid, in the new year, please do not buy collector sets, collector coins from places like the Franklin Mint. Again, no offense, guys. Good business, but it's not an investment. That's a collector value. If you really want to invest in rare coins like this, you can go to the PCGS, Professional Coin Grader Service of America, PCGS.com, I think it was, but you can want to look it up. And you can actually research about how to understand numismatics and bullion value together, but avoid collector sets. They are worth nothing. They are just basically cheap coins printed off a press, and they have only collector value, and that's it. Once that owner is gone, the coin probably gets thrown in the trash or passed on to a kid who doesn't even want it. So no more collector sets or coins like that in the new year, please. Number 4, penny stocks. I hate these things. I see penny stocks more than I should. Penny stocks are basically stocks that don't trade on a major exchange because the companies are so small and so poor, essentially, they don't have enough money to actually trade. There are certain liquidity requirements you have to have, certain cash reserves, certain asset levels you have to meet, and profitability requirements you have to list on a major exchange like NASDAQ or the New York, or be followed, certainly to be followed by the S&P 500. You have to have pretty decent results and pretty sizable balance sheets to be included in these indexes. However, that does not stop small companies from wanting to be listed. Most of these are, well, they're all sub $5 a share. Many of them are sub $1 per share stocks. They trade on over-the-counter bulletin board type exchanges. You can find them anywhere on the internet. These things are rife with fraud. Something like around 90% of all penny stocks out there in the market fail to produce a return. It's a huge, you might as well open a restaurant. It's a terrible, terrible idea for your money. I see penny stocks quite often, more than I would like. Not as much as I see a couple on my list. In fact, one I've got coming up. But I will tell you, penny stocks are just about the worst possible thing you can put your money into. in 2024, when, by the way, there's so many great companies to invest in. If you need to buy very, very small amounts of shares, may I suggest you buy fractional shares. You can now buy fractional shares on most places like Fidelity or Schwab or Vanguard or wherever. You can go on, whether it's using a robo or an actual advisor, you can buy fractional shares in small amounts, as much as $5 to $10. So really the need to invest in penny stocks on over-the-counter bulletin board exchanges, it's just not necessary anymore, given the odds are so long of making any money in these things. I honestly have never known a person in over 2 decades of doing this who's made consistent money in penny stocks. Yes, there's always that person you hear about that makes $1 million and blows it on a Ferrari or whatever using penny stocks. But I'm telling you, I have never seen anybody legitimately and consistently do it. All right, number 5, and this one's kind of fun, actually, I'll admit. Most collectibles. Now, when we talk about collectibles, there are those people, I will fully admit, who can walk through an antique store or walk through a stamp collection or walk through a whatever and just pay, and they're so good at what they do and they're so expert at what they do that they can pick the one little gem out of the million items of trash that are in that collection and go, that's the one that's most valuable. Man, let me tell you, a tip of the hat to you if you can do that. For most of you, pretty much all of you who are watching this video, you are not that person, and I'm not that person, I have to admit. So most collectibles, I hate to say it, are garbage, unfortunately. And if you've ever cleaned out a deceased person's house, or you're aware of something called the Pareto principle, you are aware of what goes on. So in order to talk about this real quickly, we should talk about something called the Pareto principle, otherwise known as the 80-20 rule. I'm going to get the gentleman's name right who coined this, because I don't want to get it wrong. The Pareto principle was basically an economist whose name was Vilfredo Pareto, and back in the late 1800s, basically 1900s, right around 1900. And it's basically a rule of thumb that states that 80% of an effect comes from 20% of an input. Okay. Now, people who love collectibles often forget the Pareto principle, because most things in life that are deemed collectibles, okay, are not worth anything. They're just not worth anything. And you see this a lot in things like stamp collecting, for example. Stamp collecting has been declining for a long, long time. In fact, most stamps on the quote-unquote stamp market, it's a pretty thin market. You don't really see much about it, but there is a stamp market. Most of the stamp collectibles on that market are down something like 70 to 80% from their values roughly 50 years ago, because these things tend to be pretty old. And by the way, did you know what the study of stamps is called? The person who studies stamps? It's called a philatelist. I didn't know that. You learn something every day. Anyway, if you are a philatelist, my tip of the hat to you. Might take my scepter and I will tip my hat to you. But trust in the fact that you are not a philatelist, and you will not be able to determine if that 1832 Falkland Island stamp from the British government is worth $1 million or $1. I don't know. Is it? Who says it's worth that? And the market on these things is pretty thin, very illiquid, and market and price discovery is pretty difficult to do. So unless you are a philatelist or some other, or maybe you're an Italian economist from 1900, maybe you should just avoid these things and put your money into actual investments that generate revenue and trade on open markets where you can see the values, and avoid most collectibles together, because honestly, they are just garbage and they are not worth your money. They will not be worth anything, probably more in the future than you spend for them now. Unless you're an absolute expert, chances are you're not. Don't put any money into these in 2024. Okay, number 6. This one hurts a little bit personally, I must say, but I have to call it out because I see it a lot. Luxury watches. Do you remember back during COVID when this big boom and this big idea about the luxury watch market started to appear, and people started talking about vintage and luxury watches as an asset class? I remember that. It turns out it was a bit of hot air, because really what was pushing that market was free government COVID money and people who were bored. And basically that was it. There are lots and lots of vintage watches on the market. I am a bit of a watch guy. People who know me know I like watches. I actually build them as a hobby, don't you know? But I don't have as much time for that. I don't have as much time for that these days as I used to. But however, I do think this idea of luxury watches as an asset class is complete nonsense. The market for these things, post-Fed rate hike cycle, has absolutely collapsed. Some interesting charts on this I came across the other day. I'll just throw a couple up here. But the market, if you can call it that, I guess you can call it that, the market for luxury watches, the prices on these things really has kind of collapsed over time. And as we've gone on, as the free money has dried up from the government, and we're kind of past this whole COVID lockdown period, and people are returning to viewing the markets as the best place for their money, or treasury bills and bonds and whatever, which is what they should be doing, okay? The market for these things really has kind of softened, and most luxury watch prices are down 20, 30, 40, 50% in a time when the investment markets have done actually pretty well. So if you are a watch person, hey, I share your disease. It is a disease. Once you get hooked on those things, it is a disease. Let me tell you, I have a few myself. And like I said, I build them. So I understand the desire. They're very cool. Love them. But investments? Okay, last one, number 7. Thanks for hanging in there with me. This one might actually make a few of you mad because I know a lot of you have them. I've got clients that have these things, and you're not going to be surprised when I call it out. The last one I'm going to talk about, timeshares. I see people with timeshares all the time. I've got members of my own family who own timeshares. I've got friends that own them, clients that own them, okay, whatever. I know lots of people that have timeshares. Now, I talk with people all the time about real estate investments and stock investments and things like that. However, I hear people talk about timeshares as if they're investments, as if they're going to be worth something that they can sell or they can negotiate. Most timeshares will never make you money. They actually wind up costing you money because there are different types of them. And people forget that there are different types of timeshares. There are leases. There are points-based timeshares. There are called RTUs, which is right to use. The vast majority of timeshares in the market are in one category called points-based timeshares. It's something like north of 80%. The vast majority of them are points-based timeshares. Now, the reason these things aren't investments, first of all, they're always costing you more money. You have to pay for maintenance. You have to pay for a lot of extra fees, association fees, all sorts of fees that you have to pay for when you own these things. And you only have a certain time of year you can use the timeshare. It's like fractional ownership in real estate. That's how it's advertised. But a timeshare basically is advertised as just that. It's fractional ownership in real estate. You can use whenever you want, or a dedicated portion of the year. And some people really love them, and I just don't understand why you would put money into it. Well, you could actually buy a piece of property or just use an Airbnb and just accept the cost and move on and treat it like a consumable vacation. The supply is always being increased. Every time someone sells a timeshare to an unsuspecting recipient who's quote unquote investing in it, the company that's doing that, and a lot of them have, I'm sure, all the major companies like Diamond International, I'm sure Hilton does, Disney probably does. Those companies are always building more of them. At the same time, they're selling them as finite resources to the current shareholders, quote unquote. So you're always being undercut or diluted as far as supply, because if they're always building more of them, then the market to sell to someone else is so hard to do. It's almost like boats, right? I live in Minnesota. We live in this weird geographic warping thing, like economic system, where it's perfectly easy to buy a boat because there's so many lakes up here, but it's impossible to sell them because they're always shipping them in here because we have so many lakes. People buy boats. They can never sell them. They can never get rid of them. It's like that old saying, it's like the best days of the boat owner's life are the day you buy it and the day you sell it. So timeshares are just like boats. They're easy to buy. They're super expensive. That old joke about what's the most expensive part, or the least expensive part about boating is the boat itself. These timeshares cost you a fortune. They're always building more of them underneath you, diluting your value. They cost you more. They have high yearly fees. They just aren't worth the money. If you're going to spend that, go rent an Airbnb, go have a nice vacation, treat it as a consumable expense, because that's kind of what it is. Understand that you're probably not going to ever be able to get your money back on these things. And if you can get your money back, it's only because you had an insurance policy, which, by the way, costs you more money, okay? So they're very restrictive. They are not good investments at all. They can't even be classified as investments, really, because you don't really own anything. They are debt and obligations, and treat them as such, and that is that on timeshares. All right, so that's it. I know you're going to do well in the new year. I'm confident. And if you have any questions on anything, or maybe you just want to argue, and that's fun too, you can reach out to me at the email below. I always put it down there. Or you can reach out to me on the website, thewell.work. That is www.thewell.work, W-R-K. I will see you next time. Thanks again for watching, and take care.